Hello, everyone. Thank you for joining us today. This is a recorded version of the Secure Act 2.0 presentation. A little bit of history is in order. Back in 2019, Congress passed the original Secure Act, which provided the largest retirement reform since the Pension Protection Act of 2006. Some of the most impactful provisions of the original Secure Act are changes at which retirees are required to distribute money from retirement accounts. And there's also a significant change in when non spousal beneficiaries have to distribute funds from retirement accounts. Both of these impact both income tax and estate planning strategies for retirement for retirees. Now we fast forward to December of 2022, Congress passed the Secure Act 2.0, which expanded some of the provisions of the original act. And so today we're going to take a deeper dive into some of the provisions that impact retirees. My name is Chris Reid, and I'm the Director of Tax Planning at Blumark Tax Advisors. I've spent the past 3 decades in some area of the financial services world, including the mortgage industry, financial planning, and of course, income taxes. Since inception, our focus at Blumark is to provide a holistic financial and tax experience by combining strategies from both disciplines for the benefit of our clients. So, just about every financial decision one makes has a tax consequence, and any tax strategy is going to have a financial impact. So, it really makes sense to work with our clients to advise and consult in both areas in conjunction with one another. Some of the key provisions of the Secure Act 2.0 are the big one was changes to the required minimum distribution age. The original Secure Act pushed that age from 70 and a half up to age 72, and then the Secure Act 2.0 pushed the age out even further to either age 73 or 75, depending upon when you were born. There are some other significant changes for those that are still working, especially in the area of retirement plan contributions. So there's significant changes to how catch-up contributions are treated, where if your income is over a certain threshold, the IRS requires that you contribute to the Roth component. And then also there are some expanded catch-up contributions for once you attain the age of 60, the IRS says that you can contribute more to your retirement plan. Also, there's some changes to the 529 plans, and if there's money left over in a 529 plan, those funds can eventually be transferred into the Roth for the benefit of the beneficiary. For a 529 plan is it's a tax preferred education savings type of an account. And also, this provision, the last provision, it really impacts small business owners or self-employed people, where historically SEP IRAs and simple IRAs, you were only able to contribute pre-tax, and now there's a provision that allows participants to contribute to Roth accounts in both of those types of plans. Secure Act 2.0, as we talked about a minute ago, changes the age at which retirees have to start taking money out of retirement accounts. RMDs have, for the most part, always been required, and the way that they're calculated is based on the year-end balance of the prior year. Then there's a calculation that you have to do every year where you're supposed to take money out of your retirement accounts, and that's because the IRS that money has never been taxed. So those distributions are going to end up on your tax return, and you pay taxes on them. So what happened with Secure Act 2.0 is when they pushed the age from 72 to 73 beginning next year. So for those of you that are born between 1951 and 1959, the new required minimum distribution age is 73. If you're born in 1960 or later, then the RMD age is pushed back to age 75. So really what that does is it allows a little bit more time where you can start planning around how much you want to take and when you want to take money out of your retirement accounts. It buys you an extra anywhere from 1 year up to an additional 3 years, which could be impactful from a planning standpoint. First, I think it's instructive to talk about how your assets are taxed. So this is really the tax location of your investments. when you think about all of your investments that you could own, all of them have a tax treatment, and they fall into one of these boxes. So we'll start at the bottom left. Whenever you have income or whenever you have investments in whether it's CDs or savings account, money market accounts that pay interest, or mutual funds or stocks that pay dividends. And when you sell certain stocks and other investments, you could pay capital gains tax. That's what's in that bottom left box. So it's money where you didn't get a tax benefit up front, meaning that I cashed my paycheck and then I went to go buy some stocks. So no tax benefit up front, but I still pay taxes on the dividends that those stocks pay. Or if I sell the stocks, I could have capital gains tax, or I could have interest on an account where I have to pay taxes on that interest. And really, that's where your assets have the most liquidity, is because you're trading in the tax liability for liquidity whenever you have funds that are in those types of investments. So now you also have in this bottom right box, it's where it's a tax preferred type of investments where you're putting money into 401ks or 403bs, IRAs, etc. And this is where you can take the tax benefit up front by putting money in pre-tax. So as an example, if you have $1,000 of income and you put 10% into your 401k, that means that $100 is not taxed. You're only taxed on the remaining $900. And what happens from there is that all of your contributions and future earnings are going to be taxable at some point in the future when you take the money out. And that's really what we're going to talk about more today, is really what the pitfalls of having larger balances in 401ks and IRAs are. Now we contrast that with the upper right box, which is where you put money into an account, a Roth IRA example. There's no tax benefits when you put money into a Roth IRA, but you're putting it in after tax. But because there's no tax benefit up front, your tax benefit is at the end. And what I mean by that is that all of your growth and then your distributions are tax-free. So it's really the mirror image of the bottom right box. So one is pre-tax, one is after tax. One, you pay taxes on all of your distributions. The other one, all of your distributions are income tax-free. And that's, of course, as long as you follow the rules that are set forth by the IRS. The top left box really represents certain types of investments that you make. And second home as an example. It's a good example. So if I go purchase a second home for $100,000 and then I sell it for $200,000, I don't pay taxes while it's growing from $100,000 to $200,000. But when it sells, that's ultimately when I'm going to pay the tax liability, and that's going to be some type of capital gains tax. 401k plans came out in 1978. And what's happened since is, with generation after generation, more people have found it easier to save into 401k plans. And then ultimately, those funds can be transferred into IRAs, which is pretty typical when someone hits retirement. But because it's been such an easy place to save, we see a lot of married couples with high IRA balances and high 401k balances. And that's what we're going to talk about, is really how to mitigate the taxes when you're required to start taking money out of those types of accounts. One of the challenges retirees are facing is that you may be in a higher tax bracket or a higher tax rate when you retire than you are while you're working. So what happened in 2017 was Congress passed the Tax Cuts and Jobs Act. And what that did is it lowered tax rates for virtually everyone. The biggest beneficiaries are probably married couples that have high incomes. And so currently, as it sits now, is you have 7 tax brackets, anywhere from 10% up to 37%. Now, if we go back to, so what's going to happen is this tax legislation is set to sunset, which basically means that the current tax rates are going to change in 2026, and they're going to go back to where they were in 2017. So right now, our tax rates are anywhere from 10% to 37%. And if they go back to where they were in 2017, then now your tax rates are anywhere from 10% up to 39.6%. So that's only part of the story. The bigger part is really what tax bracket catches most people or many people. And currently that's the 24% tax bracket. So you can have up to $364,000 of taxable income and not pay any more than 24% in taxes on that income. Now, if you're an individual, it's 182,000 or 50% of that number. Now we compare that to 2017, where the top of the 25% tax bracket is only $153,000. So a married couple that has $160,000 of taxable income is going to be in a 28% tax bracket if we press fast forward to 2026, whereas right now they're in a 24% tax bracket. So again, tax rates are headed higher, and we just have to be prepared for that. In the context of the Tax Cuts and Jobs Act, you could theoretically be paying up to 9% more in taxes in 2026 than you would pay today. So in the perfect scenario where you've got a married couple, long life together, IRA balances, distributing money out of IRA accounts and other tax preferred type accounts, is they're still going to have a higher tax bill in a lot of cases, just by virtue of the fact that income tax rates are going to increase. However, there are a couple of scenarios that are likely to happen. And one is if one spouse prematurely passes or dies before the other, which is highly likely, then the surviving spouse is going to be taxed as an individual. So that just means that they're going to hit the tax brackets a lot quicker. So when it comes to things like required minimum distributions, that could put the surviving spouse in a much higher tax bracket than they would be than if they're going to file than if they were married. The other scenario is really after both spouses pass. And then you have IRA. There could be money that's in an IRA that historically you could have your beneficiaries stretch out the distributions or take the distributions over their life expectancy. But because of the Secure Act, the original Secure Act, that precluded beneficiaries from doing what they call a stretch IRA. And now what's required is those assets have to be distributed inside of 10 years. So there's no more stretch IRA. So you have to be conscious of really where your children or grandchildren are from a tax rate standpoint. And then also, anytime you talk about the IRS getting their hands involved, is you're talking about taking a significant chunk of the legacy that you're leaving behind. Let's talk about a couple things that you can do to mitigate the tax implications. The first thing to consider is potentially doing a Roth conversion. So a Roth conversion is where you take money from an IRA and an account that you never pay taxes on it, and then you convert that account to a Roth or a portion of it. And then in that year, you'll pay the taxes on the amount that you convert. So if you decide to do a Roth conversion for $50,000, you'll pay taxes on $50,000. But then as long as you follow the rules, the IRS rules, then that $50,000 plus future growth is never going to be taxed again. That could be an excellent move. But of course, then we have to look at where you're at from a tax bracket standpoint. Does it make sense? Are you in a 24% tax bracket or a 22% tax bracket today? And do you expect to be in a 25% or 28% tax bracket later on? So it's all in the context of planning. So we need to take a deep dive in your retirement expenses, understand where you're at today, where we expect you to be in retirement, and then overlay the tax consequences to those scenarios. And again, if we expect tax rates to go up, there's a very good chance that you would benefit by paying the tax bill now versus waiting until after 2026 to pay the taxes. Another strategy is to consider moving funds to an insurance policy. Life insurance is also a tax preferred type of a vehicle because if you have a death benefit on a life insurance policy, it's tax-free to the beneficiaries. The reason why you might want to fund a life insurance policy is because maybe you want to leave a tax-free death benefit to your beneficiaries so that your beneficiaries can decide whether they want to pay the taxes on that IRA money or whether they just or whether it's for liquidity or whatever. But it does provide some flexibility from a planning standpoint where you have that tax-free death benefit from a life policy. I think regardless of what you decide, the important factor is you really need to know where you're at today versus where you think you'll be after 2026 when tax rates change. When we say tax danger zone, it's really for those folks that might have done what we talked about before, which is, you start out when you're fairly young and you contribute you contribute to the 401k plan, you get matching contributions, and then you wake up one day and you have just a sizable balance in your retirement accounts. And then even if you don't need the money, the IRS tells you have to start taking the money. So that's where we have to just understand what those tax implications are when that comes about. And that really means that if you're approaching or you're in retirement, then you need to pay attention to really how things are going to look from a planning standpoint. If you have any questions at all about any of the content here or anything else related to income taxes or strategies, we would love the opportunity to meet with you individually to address any specific concerns or questions that you have. Again, our primary focus is to provide customized solutions to unique financial issues, and we would love to sit down with you and see how we can help. So feel free to reach out to us either via our website at blumarktax.com. You can send us an email at info@blumarktax.com, or just give us a call at 248-289-1647, and we would love the opportunity to meet with you. Thanks again for joining us today. You can also connect with us on Facebook and LinkedIn. In the meantime, have a great day, and we look forward to hearing from you.